Picture a bank that cannot legally go bankrupt, even when it's already dead. Not metaphorically dead, actually insolvent. Its liabilities bigger than its assets. On paper, a corpse. And yet it keeps opening every morning, keeps taking your deposits, keeps making loans, keeps paying its executives bonuses. That's not a hypothetical. That happened for real to hundreds of banks across the United States for years in plain sight. By the time anyone stopped it, the cleanup cost more than $160 billion in 1980s money. Adjusted for today, you're closer to $500 billion. And here's the part that should bother you. It wasn't really a crisis caused by criminals sneaking through the back door. It was legal. Almost the entire thing was legal, right up until it wasn't. This is the story of the savings and loan crisis, and why the American taxpayer ended up quietly footing the bill for one of the strangest financial collapses in modern history. Here's why this still matters decades later. Every time you hear about a bank being too big to fail, or a bailout getting approved in the middle of the night, or regulators insisting a shaky institution is fundamentally sound, right before it collapses, you're watching a rerun. The savings and loan crisis was the dress rehearsal. It wrote the playbook that 2008 would later follow almost line for line. Different decade, different acronyms, disturbingly similar mistakes. So let's understand how a boring, sleepy corner of American banking turned into a national financial sinkhole. Start with what a savings and loan actually was. Think of it as the friendly neighborhood version of a bank, also called a thrift. You'd deposit your savings, and the thrift would use that money to issue mortgages to people buying homes in the same town. Simple business. Take deposits at a low interest rate, lend that money out as 30-year, fixed-rate mortgages at a slightly higher rate, pocket the difference. Boring, stable, practically designed not to blow up. For decades, it worked exactly like that. Then the 1970s happened. Inflation surged. To fight it, the Federal Reserve under Paul Volcker pushed interest rates to levels that sound almost fictional today. Short-term rates climbed above 15%, at one point even higher. Here's the problem. Thrifts were sitting on millions of 30-year mortgages they'd issued years earlier, locked in at old low rates, maybe 6 or 7%. Meanwhile, they now had to pay depositors far more than that just to keep the money from walking out the door to somewhere better. Imagine borrowing money at 15% interest to fund loans you're only earning 7% on. That's not a business. That's a slow bleed. Every single day, these institutions were losing money just by existing. By the early 1980s, the math was brutal. Hundreds of thrifts were technically insolvent, not struggling. Insolvent. Their liabilities exceeded their assets. In a normal industry, that's the end of the story. Doors close, the business dies, everyone moves on. But regulators had a different idea. Instead of closing these institutions, Washington decided to deregulate its way out of the problem. In 1980, and again in 1982, Congress passed a pair of laws that fundamentally rewired what a thrift was allowed to do. The caps on how much interest thrifts could pay depositors, gone. The restriction keeping thrifts focused on safe home mortgages loosened dramatically. Suddenly, these small-town savings institutions could pour money into commercial real estate, speculative land deals, even junk bonds. The logic, generously interpreted, was that thrifts needed room to grow their way out of the hole they were in. The actual result was something closer to handing a gambler in debt the keys to a casino and telling him the house's money is now his to play with. And this is where the truly strange mechanism kicks in. The one that turns a bad situation into a genuine catastrophe. Every dollar in these thrifts was insured by the federal government up to certain limits through an agency called the FSLIC. That insurance existed to protect ordinary depositors from bank runs. Good idea in theory, but it created an almost perfect incentive to gamble. If you're an insolvent thrift owner with nothing left to lose, and depositors are protected no matter what happens, why would you play it safe? Playing it safe guarantees you fail slowly. Taking wild risks gives you a chance, however small, of actually earning your way back to solvency. Economists have a term for this: moral hazard. It's what happens when the person taking the risk isn't the one who eventually absorbs the loss. So thrift owners across the country did exactly what that incentive structure predicted. They funded speculative office towers in cities that didn't need more office towers. They financed condo developments miles from anywhere anyone wanted to live. They bought high-yield junk bonds because the returns looked good on paper, right up until they didn't. Some of it was simply reckless. Some of it curdled into outright fraud. The most notorious case involved a man named Charles Keating, who ran Lincoln Savings and Loan in California. Keating funneled depositor funds into risky ventures, falsified financial records, when regulators started circling, enlisted the help of 5 sitting United States senators to pressure examiners into backing off. History remembers them as the Keating Five. Lincoln's collapse alone cost taxpayers more than $3 billion. That's one thrift. There were over 1,000 more failures where that came from. Now here's the uncomfortable math nobody wants to say out loud while it's happening. Between 1986 and 1995, more than 1,000 savings and loan institutions failed. Roughly a third of the entire industry gone. The agency responsible for ensuring these deposits, the FSLIC, was supposed to have reserves to cover exactly this kind of disaster. Except it didn't. By 1987, the FSLIC itself was insolvent. The insurer meant to protect the system had run out of money to protect anyone, which meant there was only one entity left standing behind all of it: the federal government, which means, ultimately, taxpayers. In 1989, Congress finally acted, passing a law that abolished the FSLIC entirely and created a new agency, the Resolution Trust Corporation, whose entire job was to seize failed thrifts, sell off their assets, usually at fire sale prices, and try to recover whatever money it could. The final bill came out to roughly $160 billion. About 75% of that, well over $100 billion, landed directly on the American taxpayer. Not the executives who made the bets, not the shareholders who cheered the returns on the way up. The public, most of whom had never heard of a single one of these thrift companies. Now contrast the hype with the reality. At the height of the boom in the early 80s, deregulation was sold as innovation, freedom for community banks to modernize, a vote of confidence in the free market's ability to self-correct. The reality was closer to an unsupervised casino wearing a bank's name tag, with the government quietly agreeing in advance to cover the losses if the bets went wrong. A particular kind of irony sitting inside all of this. The entire crisis was triggered, in part, by an attempt to fix a problem using less oversight, at exactly the moment more oversight was needed. Regulators didn't just fail to stop the fire. In several documented cases, they were the ones who handed out matches. Now zoom out, because this story didn't end with the Resolution Trust Corporation closing its doors in 1995. It became the blueprint. Deregulate a financial sector. Let risk pile up quietly behind the scenes while returns look good. Let a federal safety net absorb attention that should have gone to oversight. Wait for the moment the mismatch becomes undeniable. Then bail it out, because letting it collapse fully would be worse for everyone, including the people who never took the risky bets in the first place. Sound familiar? It should. Less than 2 decades after the RTC finished its work, the same core pattern played out again on a vastly larger scale in the 2008 financial crisis. Different institutions, different products, mortgage-backed securities instead of junk bonds, and speculative office towers. But the underlying architecture, deregulation, moral hazard, delayed recognition, taxpayer-funded rescue, was almost identical. Which raises the real question this story leaves behind. One that doesn't have a comfortable answer. If the exact same failure pattern can repeat itself within a single generation, in the most heavily monitored financial system on the planet, what makes anyone confident it won't happen a third time? Maybe the lesson was never that the system got fixed. Maybe the lesson is that some mistakes are just profitable enough for exactly the right people to be worth repeating.